Okay, let's talk some diverging consumer stocks. AutoZone has been a big winner on the year and slowing down a bit here after some numbers. And Signet, which has been a big decliner, is up 16% right now. So a little change in fate. Paul McCarthy joins us, president at Kisco Capital. Let's start with AutoZone. Paul, it's been a great year. Any reason to think that this is changing despite a little slowdown here in the stock?
I don't think so. I think AutoZone's really, they've done a great job through the pandemic. As you know, used cars were pretty much all you could get as the semiconductors were, couldn't be found for the new car products. And so they've actually done a really good job of generating free cash flow and building out their inventory network so that they can keep their stores well stocked for customers. So they actually showed a pretty good numbers. They had 5.6 increase on comparable store sales. Revenue's up about 8% over the last year. They're generating free cash flow of about $2.5 billion. They're buying back their stock. So I think that even with the new car market coming back online, you're still going to see, because prices are so much higher, I still think the do-it-yourselfer is going to want to hang on to their older cars, and that's good for AutoZone. So I do think that, I think that they've captured market share they're going to hold on to from their competitors, and I think that, the company is doing well in this environment despite all the inflationary pressures.
Up $1,500 from $1,000 pre-COVID. Okay, firstly, when are they going to do a stock split?
That's a good.
I can't trade the darn thing.
Yeah, I know. I mean, some of these companies, it's not something they really think about, but you've seen it with Amazon, Google. Clearly, it's better for liquidity. And, I think that's, I would surprise if they didn't do that next year, but it's probably due at this point. So, I mean, they're out buying their own stock, so they probably wouldn't mind to see more liquidity in the shares as well. So I think we'll probably see it soon, but,
How far, what's kind of the framework here as we're just in this nonstop rally? I mean, it seems like you think the fundamental tailwinds are still there. Does AutoZone ever go down? I mean, what's with this, there's so few charts out here that are still going up, that went up during COVID, but then also went up before. Is there a certain point where they will have just taken all the market share they can?
I think, just looking at the chart, it is a trending stock. And so that's, what you want to look for. I think in the last several weeks, it's if you look at a weekly long-term chart, you'll see that there's a negative RSI divergence building in the stock. The 55 EMA is around 2,100. So, for me, if you're not in the stock right now and you're looking for a good entry point, if you see something, a pullback down around to that area, 2,000, 2,100, that's probably not a bad area. And you see if it holds. If it breaks it, then you might obviously be getting a larger pullback. But I think the stock's a little bit extended here, despite the, and I think that means the market just sees the good fundamentals in this environment, and that what they've done over the last couple of years is sustainable. So I think that it's definitely something to target, but I would just hold off a little bit on, initiating the position right here.
Okay, well said. Paul, what about the winner here this morning, Signet? This is a stock that had been panned for a long time, like literally the opposite of AutoZone in the consumer space. And then it ramped up during COVID a little bit here, but it was like years of decline before COVID on a business model that a lot of people were questioning whether or not it really made sense. Some of the credit exposure too. What do you think about this company right now?
This is a company that does not have a trending stock. So I think that the last high was 2015, and we haven't seen that yet. It's up quite a bit. It's up 19% now, I see. But if you look over the past year, it's been around this price since May. So I really think a breakout in the over 70 to 75 would give an indication that the market's giving it credit. I think they're projecting like $12 EPS this year on the upper end, so that's a pretty low PE. But you have to think about, is this a value trap? So when you look at the same store sales, the one thing that stuck out in the report today, they were down 7.6%. So you have to ask yourself, are they selling less stuff but at a higher price? And, that I think is something I'm going to watch over the next quarter. They do about half their earnings in the January quarter. And I do think inflation does affect the diamond business. So, it's not a true commodity. Diamonds are not ubiquitous like gold or silver or something. So it's really a retail store. They sell to the middle class. So as inflationary kind of headwinds hurt, it could hurt them, I think, in the next few months. I mean, they've had a really good message this morning, but their ability to generate free cash flow has been very choppy this past year. So they've actually used or burnt cash about $155 million. So to me, this is a wait and see. I think you need to see technically a breakout into the 70s with a good amount of volume, and then maybe the PE gets up to a double digit. But I think this, looking through the fundamentals, it's definitely a much tougher look than looking at like an AutoZone. To me, AutoZone is definitely generating profits where I think Signet probably has some more work to do. They did a couple acquisitions in the last year. They've replenished their inventory, so they're assuming they're going to have a good quarter, and I wouldn't doubt it. But I'm just worried about, is the consumer going to really show some weakness where the consumer, where the discretionary income dries up? And if I looked at their prior earnings reports this year, and they actually predicted that for the end of this year. So it is a bit of a surprise to me that they had a good quarter as much as they did. But I think the stock, like it's in a very choppy range. So I would just be careful about chasing this until you start to see more of a trend. And I think that's after the stock gets above 70 to 75. So to me, this is a wait and see story right now.
Okay, Paul, thanks for the thoughts. Really good stuff. A nice setup for us to do some trading this morning. Always like the commentary. Paul McCarthy, President.
7.6.
Are they going to do a stock split